Hi, and welcome to Grandma's Wealth Wisdom. We're super excited about our conversation today with Lester Himel. If you're catching the replay, thank you so much for checking this out. Be sure you hit that like button. The comments are still open, and you can subscribe for future interviews too. I'm going to keep intros really short here because I know Lester has a lot of value to bring to today's conversation. We could say a lot about Lester, but just so you know, he's got a broad financial background and some real life experiences to back up the value that he's going to share today. We put a full link to his bio in the description. And just personally, Brandon and I have learned a lot from him. So if you've been checking out our podcast or YouTube channel, you'll see a lot of his fingerprints, but you don't know that they're his unless we've attributed to them, which we've done that a couple times. But today we're super excited to have him as a guest on this show. So welcome, Lester.
Thank you. It's good to be here.
Can you give our audience a little bit more about your background?
Well, after grad school, I went into and onto Wall Street and worked in administration, compliance, operations of all sorts. I was a bond trader. I ran trading desks. I got involved with .com here and there, emerging markets, corporate bonds mostly, anything and everything. And by accident, bringing it full scale, ended up in this business as sort of an accident.
Can you tell us a little bit about that story of what that transition was like?
Well,
what brought it about? Yeah.
What brought it about was I had a son who was in college. It was his senior year. And my wife and I were invited to senior weekend out on the West Coast. And coincidentally, 2 weeks before that, I was offered a position at an insurance company, which I turned down, thinking, me, insurance? No, I'm a Wall Streeter. The visit to the West Coast resulted in my wife and I each attending different seminars. The professors were, of course, showing what the students go through and how wonderful school was there. Well, the seminar I attended had to do with a professor by the name of Steele, who was describing a study he and colleagues had done, had to do with discomfort in a given business environment, which applied to me 100%. I was involved in credit derivatives at the time on Wall Street, and it was a very uncomfortable experience for me. So this was fitting into my psychological needs. My wife attended the lecture given by a neuropsychologist, and he was saying that every 10 years, no matter what you do in life, you need a change. You need a learning curve. So there I was after all those years on Wall Street, listening to what she was excited having heard and what I was hearing from Steele. So I called the insurance company back and said, I've reconsidered. What's our next step? And here I am.
Wow.
So that probably sounded like a big crisis of, I don't know, you probably went through almost a personal crisis at that point of, hey, I've learned all this stuff. And then this clash probably came internally for you. Do you think?
I would say that's fair, yeah. I certainly needed that learning curve that I mentioned, but I also certainly needed a change overall to give myself a sense of accomplishment or maybe a challenge. I'm not sure how that really ratio-wise came into my life, but I definitely needed something. So yeah. I started with an insurance company it's one of the largest in the world, and it's a very publicly traded company. It's also very focused on such things as what we call universal life insurance. So I learned all about how wonderful that was. And then over the course of time, found my way into a mutual insurance company and found about whole life and how that played into the realities. And eventually went independent a number of years ago. And a number of experiences.
And I want you the listeners to get, when he said universal life insurance, how wonderful it is, was a little more on the sarcastic side. So if you did not catch that, he was being a bit sarcastic. I don't know.
I can expand on that. Back in my rookie days, one of my positions on Wall Street was to redesign the Wall Street firm I was working at in every department from A to Z. And that sounds a little odd, but that's exactly what my role was in the second year at that firm. So in going from one department to another, I ended up meeting a man by the name of Jack Barger. Now that's important because he's the man that designed universal life insurance. And he tried to sell me one of the very first policies. So there I was, a kid, and he's trying to get me to buy something that life insurance, me, I'm a 20-something, what do I need that for? And I didn't understand the design anyway. But over the course of time, I got to know more and more about it because I'm a parent, because I needed insurance, because I got into the business. When I went to this public company that I mentioned and learned about the wonderfulness of universal life, it was to the, let's call it the criticisms that were constant toward whole life. Now, there's a very large story behind all of that, but in summary, universal life is a very dangerous piece of insurance. And it's only called insurance because it happens to take advantage of the IRS, the tax code.
Yeah.
And in so doing, it just leans on the fact that if it has life insurance, then it gets certain tax benefits. If there's a death benefit, I should say. So it is my position, knowing what I know about it, that number one, it's dangerous for the client that owns it. Number two, it should be in the Wall Street arena, not in the insurance arena. If you look up what a life insurance company is supposed to do, what the purpose of the company is, it's to transfer risk off the shoulders of the client onto the shoulders, proverbial shoulders of the insurance company, and take on the opportunity to work with what's called the law of large numbers, spread the risk among many people. Universal life does not do that. It leaves the responsibility for success and the likelihood squarely on the shoulders of the owner of the policy. That's not what life insurance companies are supposed to do. So I have a real problem with it at every level.
Yeah, that was really well said, Lester. 100% agree. And I know you've got some really strong opinions, and I love that you're sharing them and bringing them to the conversation today. I know one of your biggest opinions is about volatility and how it's understood by most people. Can you tell us a little bit more about that?
Sure. We start with an example of what happens with the public. A man walks into an investment advisor's office and says, I have $10,000 to invest. And the advisor, of course, says, well, that's great. We have the following opportunities. What would you like to buy?
Yep.
So he's investing, and then a year later comes back to the advisor and says, how did I do? And the advisor says, hey, you're up 10%. Sounds great. Man leaves. A year later comes back and asks the same question again. How did I do? He says, you're down 10%. Well, normal thought process there is, hey, I'm even. At least I didn't lose money. There's still an opportunity to do more next year. The reality is that's not true. If I take $100 and I go up 10% in a year, I have $110. The next year, if I go down 10%, I don't have 100, I have 99. 10% of 110 is 11. 11 subtracted from 110 is 99. Well, we get a little bit steamier with it when we talk about bigger changes. Let's imagine that my investment in the first year goes up 100%. And then in the second year, it goes down 50%. Man on the street thought is, okay, up 100, year one, down 50 in year two. That gives me a net of 50. And I have 2 years to average it over. So 50 divided by 2 is a 25% return. Hey, that's not bad.
Sounds awesome.
Yeah, let's do it with real numbers. I put $100 to work. It goes up 100% in year one. I have $200. My $200 goes down 50% in year two. I have $100. Where's my 25% return? Nowhere.
Right.
So why is that important to go through that? Because here's what happens with the professionals. And I'm truly critical of most of the professionals. Remember, in my first job on Wall Street, I actually had to test all those professionals, all those stockbrokers, as they were called in those days, to see if they knew their business and so on. So here's what happens. The market goes up 10% in year one, down 3% in year two, up 17% in year three, down 27% in year four, and so on. You take those numbers, you get the sum, you divide by the number of years, and that gives you your average return over those years. Very simple formula. Now, I've given this lecture structure explanation to professionals, 100 at a time, and they all come up with, yep, that's exactly the way it works. Okay. That is no different from what I just said with up 100, down 50 divided by 2. It's the same arithmetic. Well, here's the humorous side of the story. And this is where volatility comes in. A 22-year-old just out of college walks into an HR department at his first employer, and they sit him down. Here's a clipboard loaded with papers. Sign off on all these things you have to sign. Oh, by the way, we're going to sign you up for the 401k program here. You really ought to sign up for the 401k. And the response, of course, is, well, yeah, my dad told me to do that. I'm going to do that. That's not a problem. 401k sounds like a good idea. So the HR person says, okay, you're going to sign up for the 401k. Let's see. Over the last 25 years, the stock market's returned an average of 7.3%. So if we take that 7.3 and look forward from here, oh, wait a minute. Let's be conservative. Let's use 6.3 just to be conservative. How's that sound? Good? Okay. So 7.3, looking forward 6. Well, wait a minute. How old are you? You're 22? Okay, when are you going to retire? 65? You're going to retire at 65? That sounds like a good idea. Okay, we'll just use 65. So that's 43 years. And how much are you making? Well, hold on. Can you contribute $212? That's before tax. Can you put $212 pre-tax into your 401k? Because if you can, with every paycheck, at the age of 65, you're going to have $1.33 million. How does that sound? And of course, it's like, it sounds great. Why wouldn't it sound great?
Yep.
What just happened there is this. Looking back at the 7.3 average return over 25 years is incorrect. How do I know it's incorrect? Without even knowing the numbers? Because what they've used as return is actually change. That goes back to what I said about up 100, down 50. That's percentage change. That's not a return. As soon as you go from one year to another, it's change. When you take that 7.3 average change over 25 years, you've ignored the volatility of reality and real numbers. Then if I look forward going to 7.3 or 6.3, I can be as conservative as 1. It doesn't matter. If I look forward with that straight line projection, as it's called, I've ignored the potential for volatility. I've ignored the possibility that I might lose something and need a recovery to get back to where I started. That being the case, the numbers are fiction. Now, it doesn't mean that I'm going to do better. It doesn't mean I'm going to do worse, although statistically you will do worse. But the reality of volatility now starts to sink in, I hope.
Yeah.
So the next question you're going to ask me is, okay, so this 82 thing.
Yeah,
what
that's
will you
exactly
do when
where
you're
I was
82?
going.
Here's what I ask my prospects and clients to consider. Imagine yourself to be 82 years old.
That's hard.
It is hard. You need an imagination. It's very hard. You get to 82 years old and I say, are you living at that point off of your investments? Likely, right?
Hope
and
so.
If your investments are an IRA or Merrill Lynch account, broker-dealer of some sort, it doesn't matter. You're living off your investments. Now, you're doing something, taking money out of the investment account to pay your bills. And then the market goes down 35%, which is done 3 times in the last 20 years. What do? Do you still pay your bills? Do you get nervous? Do you worry about outliving your money? What you've just experienced is volatility. Well, volatility means up and down. And in this case, down a lot. So what you now need at age 82, let's remember you're 82. Now you need to see recovery. From the year 2000 to the year 2011 and a half was the recovery from that first collapse in the year 2000, almost 12 years worth of recovery requirement. What do you do during that period? You don't know how long recovery is going to take.
Yep.
But volatility, underline that word for a moment. Now that you've experienced, at least in your imagination, the volatility at age 82, did you have options? Were you able to go back to work? Were you able to drain some other savings somewhere else maybe, or lean on relatives, or who knows what? Now that you've experienced 82 volatility, now let's move back to when you're 45 or 50 or 38. Did you experience in your savings, in your 401k, in your investments, volatility then? Chances are real good you did.
Yep.
So why didn't it affect you? And the reality is it didn't affect you because you had an income. You were surrounded by people saying, don't worry, you have time, you'll make it up. You know, the market always goes up over time, right? All of the truisms that come out, all of the textbook answers, and let's keep the money invested here kind of answer. Once you understand that volatility was a problem in 82, then we can start analyzing how much of a problem it really is in your growth, in your savings when you're 38, 45, and 50. Put them together and you start to get a sense of what volatility really can mean to you. And it's never a positive. Never. No matter what they throw at you with it. Well, dollar cost averaging, and you know you're going to be able to buy this over here. No. Dollar cost averaging is a rationalization for taking advantage of the ups and the downs, mostly the downs, of volatility. Consider if you're at the lows and you're buying stocks at a cheap price. Well, at the highs, you're going to be buying stocks at a high price. So what's the balance there? The whole idea of volatility is a massive negative, and in particular, when you're helpless in your later years. So we have to get our arms around that completely.
Yeah. So let's say someone is like, okay, I'm willing to say maybe possibly I need to do something here to counterbalance any volatility in my portfolio. What do they do? Like what's the solution? What's the strategy to pursue?
That I can give you an easy answer and a complicated answer. And I'm going to try to get in between the two.
Okay.
The first answer is you need consistency in your growth and in your earnings and in your continued growth, presumably in your retirement years. There are very few, if any, instruments that provide that. Certainly no Wall Street instruments. The textbook approach to all of that is to use what's called modern portfolio theory, which came about in the mid-1950s, 1956, I believe. Mm-hmm. And what that does is it takes stocks and bonds and maybe some alternatives such as wheat futures or who knows what, silver, gold, puts it together in a portfolio, and you're supposed to make some sort of a reasonable mixture out of all of these things and ratio of this and versus that to give yourself some sort of consistent growth and balance off the volatility that is part and parcel of that whole thing. Here's the problem. Number one, we know stocks are volatile, so they're doing this all the time, all over the place. The idea of bonds introduced into the portfolio is poorly understood, more so than the stock side. Bonds are supposed to be less volatile, which they are. So I show people, this is the stock side, this is the bond side, stock side, bond side. But bonds do one thing in particular that stocks cannot do, or don't by design do. And that is a constant income stream, a constant interest rate, a constant coupon, as it's called, into the portfolio. So the question should be, well, why is that important? And the answer is because that's an income that offsets, in particular, the losses of stocks. So if stocks go down, you still have an income giving you a buffer of sorts against what your losses actually could come out to be. The reality of life, the side point here, when I have a new client and I go into, okay, what does your portfolio look like if they have a portfolio? And they say, well, I've got the stocks and I've got this and I've got that and I've got this over here. Do you have any bonds? Typically, it's somewhere between 0 and 7% of the portfolio is bonds. It's supposed to be, depending on how you believe all this portfolio structuring to be worthwhile, 75-25 or 60-40 or 50-50, some meaningful number. It's rarely the case in the people I've worked with. Does it exist out there? I guess so, somewhere, but it's not the standard. The idea of what to do with all of this, looking for consistency, doesn't play well with bonds, and there's another reason for that. Number one, in today's interest rate environment, bonds have very little in the way of interest. Interest rate environment we're in is very low. So how much income could possibly come into a portfolio to offset stock losses if they show up? Very little. What does that do for bonds? Well, it makes them dangerous because not only is there little income coming in, but when interest rates do eventually rise, principal value of a bond to offset the lack of interest that they're currently earning drops like a rock. So that is principal risk added to the portfolio. So the idea of consistency, we haven't gotten there yet. We're still dealing with a portfolio that has some tough times ahead. So what I look for is what's called a business model, not a Wall Street model. The business model that I'm referring to is, for example, in using whole life insurance. It's not that I have a vested interest in selling whole life insurance because that's the only thing I know. It's that I look at the portfolios that have stocks and bonds and I think, first of all, mutual funds and I are not friendly. They don't do anything for me at all. That's what's called microdiversification. It's not helpful, which we can get to in a minute. But the idea of the Wall Street model is inherently volatile. Stocks and bonds are volatile. What we want to do is get away from that. And the way to do that is to find, again, a business model that gives you fairly consistent earnings. And here's step by step what I look for, or what I found. Number one, a regimented or regulated industry. Where is that? Insurance. Now, banks are regulated, but not to the same degree and not for the same reason. The idea of an insurance industry being regulated is to, as certainly as possible, the regulators want these insurance companies to last consistently into the next millennium. Try that with any other industry, number one. Number two, the idea of the companies, if we can find a company that is consistently profitable for many, many years, not last year, not last quarter, not 7 quarters in a row, but over 100 years, we're doing ourselves a favor. We can't guarantee consistency for the next 100 years, but we have to take a best guess, an insightful intellectual guess, maybe not so much a guess, based on history, and see if we can take that into the next century. Number three, we want a business model that is not reliant on the interest rate environment, or more accurately, the economy per se with its ups and downs. Wall Street can do that. We don't care about that. We don't want that. So with that, what we end up with is mutual insurance companies. A mutual insurance company, and this has to be clear, is not owned by stockholders. It is owned by policyholders. So if I buy a policy, a whole life policy, in a mutual insurance company, I'm an owner of the company. Well, what does that do for me? It means that when there's a profit at year end and that profit gets distributed, who does it get distributed to? Me. Me and all the other policyholders like me. So the bigger my policy is, the older my policy is, the more money I make. That's the whole idea. So we want a company that is historically profitable without missing a beat, hopefully. We want a company that is regulated, consistent, and persistently giving out profits to me. Now, the business model. What is the business model of these insurance companies? It is not investments, although that's part of their game for sure. But the business model is selling insurance, collecting premiums, paying claims. Now, remember, they're regulated. So the idea of the difference between premiums and claims is presumed to be a profit. I want that model. I want to invest in that model. So if I can take advantage of that to my betterment, why shouldn't I? It doesn't mean, to step to the side for a moment, it doesn't mean that my only approach to investments should only be insurance, although I think it should be the centerpiece of every portfolio. What people seem to miss way too frequently is it's not that we should enter into a casino environment for our entire savings and financial life. Yeah. It's that we should enter into something that gives us some certainty in the middle. And if we want to play and speculate on the edges, fine. We all want excitement in life. We all go to Las Vegas at some point. But the idea of making that the way we go about, well, pardon me?
I'm not going to go to Vegas.
Well, I'm not a big bettor, but the idea of making sure that you have something that you can rely on is no small thing.
Yep.
And people tend to think that their investment advisor at some broker dealer is the closest thing they can get to heaven because this guy's promising this or saying that. There's a reason, there's a big reason that Wall Street cannot guarantee results. And that is because they can't guarantee results.
Yep.
We can.
Yep.
Yeah.
So we do have a comment here that I wanted to throw out at you. Totally say pass. James Pollard is asking, or he's saying one of the ways he protects himself from volatility is through dividend stocks. And because then he's not dependent on investment growth, I guess presumably he's getting those dividends instead. What do you say about that?
I think dividends are a nice thing to have, but the underlying principal value of the stocks that provide those dividends cannot be counted on. Long term, they cannot be counted on. Short term, maybe they'll have a good quarter, a good year. Think of it this way. Dividends were at their highs in the late 90s and then they dropped. What happens with dividends in the next 10 years? And here's a bigger challenge, a question. Name any 5 companies that you are confident will be around in 10 years. There's a challenge. I don't know which companies will be around in 10 years, aside from the insurance industry, which I do have a bit more confidence in. But the idea of, will IBM be there in 10 years? Will Facebook be there in 10 years? Will GE? Oh, look what happened to GE over the last 10 years. Yeah. The idea of consistency and certainty, and to the question, let me pose this. We don't deal the way Wall Street does in 1 and 2 year game plans. When you walk into your advisor at a broker dealer and you say, what do you think is going to happen in the next year? That's how they play. They have an analyst, they have an economist, they have a team of analysts and economists. And they'll tell you, well, we think on the next year, and interest rates are going to be in this and this and this, and that's great. But when you come to me, to us, what you're really trying to accomplish is not a 1 and 2 year game plan. Mm-hmm. That's basically a wet finger to the wind. Well, which way do I think the wind's blowing now? What we have to deal with is 50-year game plans. Someone that's 25 is a 75-year game plan. We have to deal with something that gives us some level of certainty long term. And we can't be dissuaded from that direction. Not if we're doing the right thing for our clients. So the idea of, yes, dividends are important. Yes, the stocks and the companies that provide the dividends are cool. But for 50 years? And one of the implications is when you look forward to where you're going to be financially in 10 years, 20 years, 30 years, and 40 years, when you're young, when you're 25 and 35 and so on, you tend to put together what I would characterize as a complicated portfolio. There are 3 silos in the financial industry, in my view. One is banking, one is investments, and one is insurance. Now, in 1990,
talk to each other.
They talk to each other a certain way,
yeah,
by competing, right?
Yep.
The idea in 1999, when the Glass-Steagall Act was repealed, was that all 3 of those were going to eat each other's business. And they quickly found out that it's not as easy as it sounds or looks. But here's the key. Over the course of time, they have become, and they've shown themselves to be very, very adept at creating new products to sell. Mm-hmm. They are terrible at showing you how those products work together. And frankly, they don't care. They've got this department that sells CDs, and they've got this department over here that sells life insurance, and this department over here that handles mutual funds, and so on. All they want to do is, in each department, show their P&L, get paid at the end of the year, and off they go. What we have to do is make your life financially simple. And when you're 35 years old, you've got kids, you have to have a 529. You've got kids, you have to have term life insurance. You've got kids, you've got to invest for the future. Wait a minute, you have a spouse, you've got to start retirement savings. Wait a minute, you need a car, you need this. It just compounds and gets more complicated. And by the time you reach near or at retirement age, you've got all this stuff. And then you have to start figuring out how it all works together. Now, what are you going to do? Who are you going to call? It's funny that the number of people that I see and that we see in our practice that are between the ages of 55 and 70, it's not that that's a sweet spot. That's the complaint spot. That's where people come in and say, I'm thinking of retiring. I just don't think I have enough money. Or I was hoping I'd have 1.33 million by now. I've only got 347,000. I don't know what happened. Do you have any suggestions? The idea of
can you fix it right now? That's what they want. They want us to fix it.
That's right. Boom.
And then they'll ask Ray to return questions.
What they really end up with, what we end up with, is more often than not, and for all those people that don't have the wherewithal to come in and ask the question, they end up reaching the age of 65, 70, and 75, and they become what I call a discarded client. Discarded by the advisors that they've had in the past, either because they outlived them, or the advisor doesn't care for their business anymore because there's no new profit in it, nothing to sell. The idea of someone being in their 70s and 80s and not any longer knowing what they have and what to do with it, or how it might work against or for each other, is all too common. The idea of simplifying your financial life goes way back to what you should be doing way before that happens, so that you don't have to rely on which stocks do I sell, which bonds do I sell, which fund is the right fund to buy, what do I do with all this complicated stuff if it turns out to be a complicated affair. And
I have one thing I was thinking, or two of things. Our podcast is called Grandma's Wealth Wisdom, and the tagline is sometimes intelligence skips a generation. And what I talk to younger clients about, I said, we're in a all-time high in the market, right? And I deal with a lot of people that are dealing with their parents, what to do with mom and dad. And I asked them, we're at an all-time high. How did that work out for mom and dad? And if you're doing the same thing and expecting different results, that's the definition of insanity. So maybe we should think differently about our finances, and that whole idea of it's in community or some in connection. And then I wanted to go back to James's conversation, and what you said initially is it's a business model. Why I like what we do and why we even love this concept is because we're business owners. We wanted to have, our biggest investment was our business. We wanted some stability, and I wanted a stable business model. And James, I know, is a business owner as well. Do you think that business owners get that business model idea more than the other guys, right? Are they just being like, hey, I just need to follow everybody there, work for the man, and it all work out? Do you think that's
Yeah, I think there's a certain level of blind faith that goes into 401ks and IRAs and just investments in general because of what's called principle of social proof. My neighbors are doing it, my relatives are doing it, therefore it works. Mm-hmm. And the guy, the man, the person, the woman that owns a business, I think has a different viewpoint on life. If they're not a W-2 employee, they have a sense more of, I can rely on myself, I'm going to invest in myself first. And the idea of, logically, a business model, if the model makes sense to me, why wouldn't I follow it? But that's the key point there. Again, people don't know what questions to ask. They really don't, especially when it comes to finance. They don't think about finance every day. They don't study it. They don't get involved with the nitty-gritty the way we do. The idea of leaning on yourself in a business model, I agree with you. That would be probably a very solid viewpoint.
And that's what I think about James is he is he has policies and he does use his business system to do the things with what he's doing with the other things, right? The dividend, right? So he's maybe thinking about, hey, and he understands his numbers, or at least tries to. What a lot of people do is they blindly say, here you go, here's my money, but they're not actually seeing how they all work in unison, or knowing, hey, I need to make a change, because they're not actually keeping track of their numbers. Does that make sense?
Sure.
Yeah. And James has been interviewed on this show before. If anyone wants to hear his story, they can go back and find that video. Lester, you mentioned people don't know what the right questions are to ask. Can you give us some of the questions that people should be asking whoever the financial professional they're working with, or maybe they're doing it themselves? What questions should they ask themselves about their financial futures? Let's start with what will you do when you're 82? That's probably a great one to start with.
Yeah, and let me repeat a phrase I gave earlier. In this industry, the business is done ass backwards. That is, and it goes back to the somewhat comical dark humor story about you're 22 and walk into HR for the first job, and you fill out the papers and you're told this is the thing you're supposed to do. It's very similar when you walk into an investment advisor's office, in my experience. And remember, I tested these people constantly. That was quite a part of my career. Walk into a new broker-dealer, a new investment advisor, and he says, that's great, sit down, good to meet you. How much money can you put to work? $100,000, that's great. Okay, and how much more can you contribute every year, and for how long, and when are you going to retire? Again, we're trying to figure out starting today, and when are you going to walk away with all this cash? So, okay, the story continues. The average return over the last X number of years was this, and if we look forward, we can project this. And our investment advisor group over here, this economist says it's going to do this year, and our analyst says this is the fund to use, and so on. And they say by the time you reach 65, you're going to be worth this. They don't typically say, now, when you're in your retirement years, have you considered one of you might die before the other? One of you might need long-term care. In fact, statistically, both of you will. One of you might need more attention with this, and maybe the expenses will be that. And when they say that your requirements for income, because you're going to travel or you won't travel and you're going to need less money or more money, we think taxes are going to go up or down or sideways when you're in retirement. All of these questions are ignored by so many of the advisors out there. Am I at risk in terms of someone contradicting me, saying you're just wrong? Fine. Find the advisor that is doing all of that, and you're in good shape. Most advisors do not. Yeah. They don't want to address long-term care when you're 40 years old. Why? Because that's the threshold upon which long-term care policies start getting sold. Why do they only why do they only go on sale, let's say, at the age of 40? Because that's when the least resistance starts. Or more accurately, the insurance companies have the wherewithal to when it gets very cloudy. Yeah. But the idea of long-term care policies, no one wants to talk about long-term care. The advisor doesn't, the client doesn't. I've sold long-term care as a rider on a whole life policy to an 18-year-old. And I'm looking to do more of that. The idea of anticipating the worst is what planning is supposed to be. It's not supposed to be anticipating the best. So the idea of putting all of these things into some sort of a package, again, if you're not being asked or you're not asking about what happens when I'm 90 years old and I have no options and the market goes down, what are you putting me into that addresses that? And to be more specific, and I hope clearer, if you're lining yourself up to be in a volatile investment environment when you're in your 20s, 30s, 40s, and 50s, funds, stocks, bonds. Again, I'm not anti-Wall Street purely, but to continue that game and have that kind of investment scenario in your 70s, 80s, and 90s, Does that make sense?
Yeah, it totally does. Like, it doesn't make sense, but I'm following your logic. It's like the people say buy and hold, but if you're going to buy, you got to be able to hold like for real, but that's like impossible. I think I've heard you talk about that before. You can't buy and hold.
Well, there's an Ibbotson chart that professionals tend to look at, saying if you put $1 to work in the stock market in 1928,
Yeah.
today it would be worth $15,412 or some silly number. So when I'm asked about that chart, I pull it up on the computer, or actually I have a full scale poster here. But I ask one question. Great. In 1928, what was the stock you bought that made it to the $15,412 figure? Every one of the stocks in the Dow Jones Industrial Average in 1928 is no longer part of the Dow Jones Industrial Average. So the idea of looking at these charts and graphs and saying, yeah, but fine, how? These charts and graphs are created backwards, right? Somebody sat here in the year 2012 or 2019 or at some point and said, gee, if I put money to work in the Dow would have done this and this and this and this and this. But the reality of the investments is, how do you know what to drop and when, and what to pick up and when? And if you don't have that in front of you, neither is the guy at Merrill Lynch. So that right away should throw a series of hurdles in front of you. To assume the best of the stock market is not realistic. And that's why Taleb, a number of years ago, wrote a book about black swans. The unexpected in the investment arena is to be expected.
We actually had two people on our YouTube channel, and you guys can check it out. Perry Marshall, and who's a really amazing speaker, 80/20 sales and marketing guy, and Mike Michalowicz. Both said the idea of black swan events are going to happen more and more frequently. And Mike Michalowicz said we're in the age of agility or something like that, meaning black swan events are going to happen. And now black swan events are events that, hey, I didn't think that was going to happen, and that affected my.
Who knew?
Who knew that a barge was going to get stuck and affect prices, right, in the peninsula? Or we were in North Carolina, and who knew there was going to be a hack when we went to North Carolina and there'd be no gas? Like, we didn't know. And that was a black swan weird event. And there's going to be more of those things. And that kind of scares me. And then what happens now, and I have this all the time, people are now asking me, what happens if the dollar collapses? Or should I do this or that? And I'm getting a lot of those questions more now, and wanting to see double-digit rate of return, but then they want the guarantees. How do you answer that when they're asking, well, what if this? And what if zombies attack? How's my policy going to perform? Anyway, this does happen.
There's a lot to that. The first thing I would point out is that, yes, I agree. There's going to be more and more of these black swan events. And I referred to it on my blog as turbulence. I used to talk only about volatility. Turbulence outweighs volatility. Turbulence is just rougher. And the idea of, back when I started trading years ago, I got caught up in what was called at the time globalization. The idea of globalization, now it's behind us. Everything is global today. So the idea of an economy in Europe not affecting us, no, maybe in 1860 with some minimal effect, but today it's direct. And the effect of any turbulence, which could be anything from geopolitical, economic, climate, you talk about any source and you'll find a way to destroy or to change or to elevate the level of volatility that you're going to be seeing. But the answer to the question, unfortunately, and this gets a little bit into the erudite arena, whenever we buy anything, we tend to compare it to something else, right? even down to, so I buy blue socks or red socks because I like blue more, therefore it's worth $1.98 more than the red. There's a comparison, but it always settles into what you want and what the price is. When you buy a house, you've got to get a mortgage and you're going to see 3.25% versus 3 3/8. There's a comparison. Which bank should I use? When we talk about what we're talking about today, investments, there is, again, comparisons. It's automatic. So if someone says to you, well, should I be buying this life insurance and why? What's the big deal? What are you trying to tell me? What they're doing is they're saying, what's the rate of return? If they don't use those exact words, that's what they're thinking regardless. And they're asking you, will it outweigh, will it outperform, will it do better than my buddy over here at this broker dealer? Or what my cousin told me over the barbecue that he can get? Yep. And your answer, my answer tends to analyze first the comparison. Why are you comparing it to the stock market? Let's go back to the last 25 years, 7.3%. No. Let's talk about what it really did, or what your perception is suggesting, and how we can then take the real numbers, and then let's talk about why we have something worthwhile. So unfortunately, it's not a two-word answer, but the idea of the comparison is key to everything we do in the financial world. That has to be understood. Once we're there, then we can start to really figure out what we're talking about. The reason that whole life insurance as a comparison makes more sense to me than bonds, and I think stocks, but funds anyway, is the consistency of earnings will outperform funds, bonds, and I can prove both. Long term, I'm not suggesting like a given fund won't outperform the index in a given year. I don't know. But over 10 and 20 and 30, 40 years, I'm pretty confident that I can do well. And the idea of that comparison striking home with the people asking the questions, that's where you have to go. So again, it's not a two-word answer. In our business, it's all too easy to say, well, look at this list of great attributes that we're showing you. But that doesn't ring a bell in any one particular mind, does it? I mean, what you're saying is, yeah, it has this and it has that. But my buddy over here at this broker dealer, he's telling me I can get 17% this year like I did last year. No, over 50 years, what's going to happen? Over 10 years, what's going to happen? So going to the other part of the question about, well, what about the dollar loses its value and so on? A bigger answer traditionally has been, which I do buy into, my liabilities have to play a key role in this analysis. If I'm investing in Europe, in the euro, because I'm going to live in Europe, then I have to be paying attention to what the euro does. If I'm living in the US, my liabilities are here. Does that mean I ignore inflation because all the products are made in China? No, I can't afford to ignore it. But I can't go crazy with this. I have to figure out where I can afford to invest, to what degree. I still want certainty overall in what I'm going to end up with over the course of time.
I think that's huge. I mean, like, it's more than just buying a life insurance policy versus stocks. It's what do we do with our everyday money, and our voting with our dollars actually matters. And I could go into all kinds of politics here, but really, we can sometimes say, oh, I'm making all this money on this thing that's helping Europe grow, or this grow, or whatever, and helping my funds grow, but then we're divesting from our own backyard almost. And that's why I like somewhat the business model for me of thinking about, hey, what am I doing to help build my own backyard, I guess. Does that make sense?
Sure.
Yeah. The problem is that there's just too much to learn, right? You can't know everything, and politics does influence the economy and vice versa. Like, most people are talking about the dollar collapsing or cryptocurrency taking over, but nobody's talking about things like, I saw a news alert today that the Congress is starting to pursue antitrust, and that has to have an impact on the stock market. I have no idea how it couldn't, right? And I know you're in New York. I think New York State is pursuing some antitrust work too on a state level. Lester, I don't know if you know anything about that, but I think that can reshape our economy more than cryptocurrency probably will in the next few years. But nobody's talking about it because it's not being popularized, which actually I have to, you mentioned globalization. There's actually a whole movement. World Localization Day is coming up 9 days from today. It's June 20th. I'm going to put a World Localization Day, all about supporting and promoting local supply chains and making sure we don't have a shortage of things within a local area just because halfway around the world some ship got stuck in a canal or there's been a tsunami or an earthquake or something like that. Nobody's talking about localizing supply chains except for this group, from what I can tell, and a couple others. So I wanted to give a shout out to them because, like, I don't know, you guys probably have never heard of World Localization Day before today, but it happens.
Yeah, I didn't.
We're going to have to rent garages to store the toilet paper, right?
No, like we've had shortages of semiconductors, shortages of IV bags, all kinds of shortages because we've globalized our world.
Sure. And I am not a fan of Starbucks. As you guys know, we are not fans of Starbucks. We haven't drank Starbucks for almost 20 years, owning a coffee shop. But I heard on the news the other day that there's a big shortage of products, and they were just saying it's just going to affect you. You're not going to be able to get your latte because there's a shortage of supply. Now I don't know what happened. I didn't totally watch the whole thing, but I'm like, this is interesting that we're going to not have our chai because and coffee, like that's happening too. And it's just interesting how it's going to affect us. Now we're not going to be able to drink our latte.
Well, on a small level, we're talking about, yes, local and yes, specific products, but on a broader scale, how's that going to play into the stock market? How's that going to play into the bond market? Right. How does that affect the credibility and the credit worthiness of bond issuers, for example? It's a growing problem. And yes, the news is making sure that they get some readership from all of this speculation and from all of the alerts coming out. But the reality is things do change, and we just have to adjust accordingly. So again, I'm not a fan of mutual funds, and I actually did say some time ago now that I would mention why. Here's why. Mutual funds are what I refer to as microdiversification. Now, diversification in a portfolio is supposed to be you own, say, antique cars, stocks on specific companies, by the way. Ming Vaz, you put money into things, coins, Krugerrands. You put money into things that if one dips because a weak market appears, it doesn't affect the others, non-correlated assets. Mutual funds are a diversification of a different sort. And that is, if I put money into, let's say, 10 different stocks, all in the tech field, IBM, Facebook, the FANG stocks, basically.
Yeah.
If I do that, am I diversified? Yes. If one company goes to zero, the others presumably do not. However, if the tech industry stumbles, are they all going down together? Yes. Yep. But more important, imagine now you're you're investing money in a mutual fund, which has inside it, let's say, 100 different stocks in a given industry. The idea is that if one goes to zero, you're not going to lose a lot of money because the other 99 stocks presumably don't go to zero. But here's the problem. One goes to 1,000 and the other 99 stocks stay stable. Are you going to feel that one stock going to 1,000? No. And you're being charged for the privilege. So the idea of fees and lack of, let's call it, growth potential in comparison to even an index that it's related to, whether it's in the S&P, the Dow, whatever, what you're doing long-term is you're trailing the index by virtue of that fund's micro diversification. If you're going to trail the index, What you're really saying in investing in funds is you think the market's going up. You don't know where, you don't know how, but it's going up. That's what you're doing by voting with your money. So if that's the case, doesn't it make more sense to just ETF on the index? Why bother with the funds? The fees are higher. They're not going to get you anywhere. Again, long term, whether you feel that tech stocks are going to do well in the next year and a half and the funds are a best way to attack that, then fine. But if you're dealing with a 401k, you're dealing with an IRA, you're dealing with just general investing, and your investment advisor says, here's a hot little mutual fund, we can hold on to this for the next 10 years. No. So I'm not a fan of mutual funds. They also end up getting inundated with stocks that Wall Street can't sell. They're not the popular items. There are some good ones in there for sure. You can buy them in the open market, but generally speaking, you'll find a fund all over the place. Many funds that have stocks that no one else wants to touch.
Yeah. So
I was going to add, what would you tell people who are like, well, I can do this, I can time the market? There's a lot of like the FIRE movement that are like, I'm awesome, I'm better than everybody else. And you probably hear that. Well, that I know the average is this, but my portfolio says this.
Mm-hmm.
You got those people, and they're on YouTube a lot.
Mm-hmm.
What do you say to that? And sometimes not even really tracking the numbers right. I see videos on that as well.
I have two answers.
Go for it.
Number one is, don't you want some certainty in the portfolio? So 100% should be, I can time the market right. I don't think that works. I know that no matter how good you are, you're not 100%. Second, what will you do when you're 82? We tend to think that I'm going to be as lucid when I'm 93 as I was when I was 23. I know there's some people out there that they fog over and yeah, grandpa wasn't really thinking clearly, and that's not me. I'm good. I'm solid. I'm 100%. Sure. But don't you think it would make more sense to put together a structure, a portfolio, a plan that takes into account the realities of life? And I still believe that the centerpiece should be something with certainty and safety. If we can agree on that, and you want to play on the edges with, I can time the market, again, fine. But it's not that everyone is going to agree with what I'm saying, or any way you put it. There are a certain number of people out there that no matter what you say will always believe they can do better, and maybe they can. But statistically, that's not the case. Statistically, we need certainty in life. Statistically, we need a way to compare against realities and make sure that we cover and address all of those negatives that could come our way, and black swans.
Yeah. I know we're running short on time. Anything you wanted to make sure that you share today that you haven't gotten the opportunity to?
No, I think I've covered a lot of territory. Happy to field any more questions that come in, but no, I've gotten on my soapbox quite a bit today, and I think that's about as much as I can do.
Yeah, I would just say I'm sure. So Lester is I want to talk to everybody listening right now or watching. Lester said some really heavy stuff today. And I know I've needed to hear some of the things he shared multiple times and then research them, run the numbers myself, look for the alternatives. And every time I've done that, I've always come back to what he said as, yeah, I agree with that. So you might have heard something today. You might be like, I'm not sure about that. You might need to go back and listen to it a couple of times. You might need to start researching, run the numbers. We encourage you to do that and let us know what results. And if you want to chat more with Lester, click the links in the description to check out his bios, and you'll see his contact information there too. And of course, you can reach out to us as well. Let's everybody thank him for being here today. And you can use the comments if there's any final questions or thoughts. Brandon, I'll hand it over to you to wrap up anything else too.
Yeah. Well, any final thoughts, Lester, before I wrap it up?
Okay, one thing. When you're looking at the performance of your 401k or your IRA, don't assume that what they're telling you is accurate. you have to really do the arithmetic and figure out exactly what the results have been.
I think that's a mic drop right there. I think that as you guys are listening to this, we'll be sharing this out a bunch. Rewatch this video, and really what he's saying is do your math yourself, and don't even trust people like me or Amanda, or like, hey, do it and vet it and everything. Like, I mean, of course I want you to trust me a little bit, but really take ownership. This is only your future, and only you at 82 that we're talking about. So take this serious, and take the time. As much as we take the time to watch marathons of TV shows, like all the time in TV, we should take just as much time for our own financial future. With that, you guys, again, take charge of your cash flow, leverage your assets, and break through to a smart, stable financial future. Don't forget to subscribe, write a review, do all kinds of fun stuff, and I'd love to hear from you.